Hello, dear students. Good morning.
Good morning, Professor.
Today we will discuss the new chapter Financial Forecasting and Planning.
What we will learn in this chapter.
You will learn introduction of financial forecasting, full step of forecasting, sales forecast, percent on sale method, key factors of percent on sale method, case studies and their solutions. Let me explain introduction. Forecasting is integrated with planning process. When organizations are planning for expansion of the business, the meaning of expansion is increasing of their production, launching new product, opening new branches, etc. They need to forecast the financing need for the future financial management. Let me explain the important full step of financial forecasting. Estimate the organization's sale revenue, expected expenses over the above sale, estimate the requirements of investment in current assets and fixed assets, decide the financing need of the organization. As per the above four steps, it is clear that the basic need of financial planning is sale forecast.
What do you mean by sale forecast?
Sale forecast is based on the following two assumptions. Number one, any past gain on sale which are expected for the next year as well. Any special event which might be influenced or increase sale. This is based on the percent on sale method. What is percent on sale method? Let me explain. To identify the need of financing in the organization, mostly used method is percent on sale method. There are many methods, but this is a mostly used method. This method is involved for estimating various expenses, assets, and liabilities required in organization for future period. I know the next question is coming in your mind, that is what is percent on sale. So let me explain the key factor of percent on sale method. As sale volume changes, the level of assets required to support the firm change. You know that if we are increasing sale, we need to increase the product as well to sell in the market. This is the one. Second, assets are financed by the liability and equity. So changes in our assets lead to change in the liability and equity as well. We know that whatever money we are investing in the business, we are managing assets through that money. That money either owns money or we are borrowing from outsiders. So either the liability or equity. Moreover, current liabilities such as account payables, accrued expenses vary spontaneously as sale changes. This is also, you are very much aware. Retained earnings are impacted by changes in a net income and dividends.
Good, but if possible, Professor, can you give any live example for more understanding?
Examples always helping to understand the methods. So let us start case 1. Here, case 1 is going to be explained. On the basis of the below information, calculate for ABCL Corporation that how much discretionary financing will needed next year. Chief Financial Officer predict that the firm's operating expenses, current assets, net assets, and current liabilities will be remain at their current proportion of sale. Suppose this year expected sale 32 million and next year forecasted sale is 40 million. Suppose net income 5% sale on constant basis and fixed dividend payment 50% of earning every year. This year ABCL projected balance sheet is as follows. ABCL balance sheet on a projection basis. We are having three columns here. The first column is assets and liabilities column. So it is mentioning assets and liability along with the equity. Second column is based on the this year sale, that is 32 million. And now we are going to be identify the percentage on 32 million sale. So first we are having current assets 8 million, we can calculate 8 million sale on the basis of 32 million sale. We'll get the percentage. Here we will use the formula 8 million divided by 32 million multiplied by 100. It is become 25%. Same as when we are going to be find out the fixed assets percentage on sale. So it is 16 million divided by 32 million multiplied by 100. It is become 50 million. Total sale, total current assets is mentioned here 24 million. Now same as we are coming for liability and equity. Account payable is mentioned 4 million out of 32 million of sale. So once we are going to be identify the percentage ratio, we can get to know that 4 million divided by 32 million multiplied by 100 is become 12.50. Same we can use for the accrued expenses, and we will get the 12.5% of percentage on sale. Notes payable is mentioned 1 million, but the most important thing here, it is written NA. The meaning of NA is not applicable. It means in this situation, we will not use the percent on sale method, especially on notes payable. So it will be remain sale in a forecasted time. Same as long-term debt mentioned here 6 million, and it is mentioned also NA, means not applicable. So it means again we will not show any change in projected balance sheet. When we are going to be calculate, we will get that 15 million is total liability. Now we are going to be discuss about the capital. In capital we have a common stock 7 million and retained earning 2 million. In front of 7 million it is written NA. It means common stock is not going to be changed when we are going for predicted balance sheet. And retained earning, as you know that nothing is mentioned here. It means it is showing that we have some calculation over here. When we are calculating both together, we are getting 9 million. So 15 million and plus 9 million is become 24 million. So it means we are having balance sheet with equal 24 million. So for the calculation of discretionary financing needed, we are using the formula is here. Predicting discretionary financing need is equal to projected total assets minus projected total liabilities and minus projected owner's equity. So now we are coming for solution. After discussing the case, let us go for the solution. In solution, again we'll make 3 columns. One column is showing the particulars. Second column is mentioning here the percent on sale with 40 million, and we have to be apply the same percentage on 40 million sale, and we'll see that what the projected balance sheet would be. So in assets, we are having current assets. As we already calculated, the percentage on sale is 25%. We'll implement 25% on 40 million sale. So 40 million multiplied by 25, you will get 10 million. Same as when you will get that fixed assets 40 million multiplied by 50%, you will get 20 million. So now total assets is become 30 million. Same as we are going for liability and equity, when we are applying the same percentage 12.5% on sale, we are getting the sale is 5 million. Same accrued expenses, we are getting again 5 million. We remember, as I told you before, notes payable when we wrote here not applicable, it means it is going to be come in the same value. So as before also we are having 1 million, here we inserted only 1 million as a notes payable. Same long-term liability or long-term debt. Because of not applicable, we put the 6 million as the same as projected balance sheet before. Now total liability comes here 17 million. We are going for capital evaluation. Common stock, it is mentioned over here not applicable. So again 7 million as per the previous balance sheet. Retained earning changed. Now it is showing here 13 million. It's important to understand from where we got 3 million. Equity the same. Now we are having 3 plus 7, 10 million. We mentioned here, and the total liability and equity is become 27 million. So here we found that total assets is not equal to total liability and equity. It means we have need some discretionary finance. First, we have to be identify the retained earning. Retained earning is a total earning and multiplied by 1 minus dividend payout ratio. As you know that total earning is based on 40 million of sale multiplied by 5% and dividend payment is 50% of total earning. So once we are calculating, we are getting 1 million is a retained earning. So retained earning is, as you know that before we had 2 million, now we included our add plus here, that is 1 million. So it become 3 million is a retained earning. So this is what we showed in a balance sheet over there before. So now we are going to be calculate the discretionary financing needed. We have projected total assets minus projected total liabilities and projected owner's equity. 30 million is a projected total assets, 17 million is a projected liability and 10 million projected equity. So the difference is coming 3 million. 3 million is a discretionary financing what we need for maintaining 40 million of sale revenue. So this is the conclusion we can say after solving this percent on sale method. If we want to achieve 40 million of sale, we need to arrange 3 million to run this business.
Can you give any other example, Professor, for more understanding?
In some different way, but we will use the same procedure. Let us go with the case 2. Same ABCL Corporation. Our enterprises is evaluating its financial requirements. For the coming year, Chief Financial Officer predict that the firm's operating expenses, current assets, net assets, and current liabilities will remain at their current proportion of sale. So if you see that from first case and second case, we just copied the same language because you have to be understand in proper way. Last year, ABCL have 12 million sale and net income $1.2 million. The firm expected the next year sale will reach 15 million. And net income will be rise by 2 million. So given the percent high rate of the growth, the firm retain all its earning to help cover the cost of investment. You are required to calculate ABCL Corporation that how much discretionary financing will need next year. Balance sheet of ABCL Corporation is here. So assets, we are having current assets. And this year sale is, as we mentioned, it is 12 million and percent when we are calculating on that sale of 12 million, it is become 30% on 12 million. So we will get to know that current assets we are having 3 million out of 12 million. So we can multiply 3 divided by 12 multiplied by 100. So we'll get 25%. Same as we can use 6 million divided by 12 million and multiplied by 100, we will get 50 million or 50%. So it means the current assets on the ratio of sale is 25 and fixed assets is 50%. And also we can get to know that we are having total assets that is 9 million. So now we are going for the liability and owner's equity. We are having 3 million as a accrued account payables. If we are going to be use the same 3 million divided by 12 million multiplied by 100, we'll get 25%. And it means 25% of sale we are having account payable as well. Long-term debt, it is again written here, not applicable, it means it will not change. Total liabilities, we can say now here we are having 5 million. We'll go for the capital. We are having common stock 1 million. Paid in capital, we are having 1,800,000 and both are written not applicable. It means keep it in your mind, it is not going to be changed when we are going for prediction or forecasting. Retained earning is mentioned here 12 million and if nothing is mentioned here, it means we need some calculation for retained earning as per the instruction given in the problem. Common equity, now we are having total common equity is 4 million. So 5 million plus 4 million is become 9 million. So balance sheet is managing 9 million total assets and 9 million total liability and equity. Let us go for the solution of case 2. Forecasted balance sheet we prepared. Now we have same. Here I am going to be show something little bit change. I am not going to be remove the question. We are going to be solve the answer along with the question. So you will get to know that here we are having not 3 column and 4 column. The first 3 columns are same, means we are having the same assets and liability column. We are having this year sale mentioned here as already mentioned in your previous question. And now we are going to be know that percent on sale will get here, and we already calculated the current assets is 25% on sale. So 25% on sale. Now next year sale we are predicting 15 million. So 25% of 15 million, we will get to know that the value of current assets will become 3,750,000. Same we will apply for fixed assets. Fixed assets is 50% of sale. So once we are going to be apply for new sale, we will get the 50%, 7,500,000. And the total assets now we are having, that is 11,250,000. We'll go for liability and owner's equity in the same way, and we'll calculate the account payable. As we know that account payable have 25% of sale, so this will be again going to be calculated on current sale. Current sale is 15 million. So 15 million is 25% become 3,750,000. Keep in your mind, already we discussed long-term debt 2 million, and it is showing that not applicable. So it is the same as before, we just insert here for more understanding. Before we are having total liability 5 million, but now total liability increase 5,750,000. As we are going to be discuss the capital. Common stock was 1 million. It is become 1 million here. Same as paid up capital, we are having 1,800,000. Same here, 1,800,000. Retained earning we had 1,200,000. Now you can see that it is change. Why change? This is a question. I will explain to you. Common equity, before we had 4 million, but now we get to know that 6 million, and one we are going to be add the total liability here and common equity here. We get 11,750,000 total liability and equity. So let us first, I will explain to you how to calculate a retained earning. As in the previous case, retained earning is equal to total earning and multiplied by 1 minus dividend payout. As you know that here total earning is 2 million and there is a 0 dividend payout. So it means the retained earning is become 2 million. It is same as before. And you know that we showed that retained earning is 1.2 million was before, 2 million now, and it is become 3,200,000 what we showed in our projected balance sheet or forecasted balance sheet. Let us go how much financing is required to manage this business. So we'll use the same formula, projected total assets minus projected total liabilities and minus projected owner's equity. What we are having? We are having total assets 11,250,000. We are having total liability 5,750,000 and owner's equity is 6 million. It means here we are having owner's equity along with the liability that is more than the required amount. It means we can say that the difference shows that the already have enough fund. It means we are having already enough fund. So no need discretionary financing. We don't want finance from other source. We are already having a lot of money. to manage 15 million of sale. So now this is a time to work from home. I'll just bring a small case in the same way to work on this case at home. Try to solve it. And if you face any difficulty, don't forget to ask any question in the comment box. And definitely you have to be like and subscribe my videos and inform to the other your friends. They will get more benefit in their education life. So let me explain the case and then we'll discuss further. ABCL company is evaluating the firm financial requirement for the coming year. The firm has only been in business from last 3 years. And the firm's chief financial officer, Mr. Steven, predicts that the firm operating expenses, current assets, and current liabilities will remain at their current proportion of sale. Last year, ABCL had $20 million sale with net income of $1 million. The firm anticipates that next year's sale will reach $25 million with net income raising to $1.5 million. Given in the present normal growth, the firm's shareholder decided to retain $1 million from the earning to help to cover the cost of investment. You are required to calculate for ABCL Corporation that how much discretionary financing will need next year, and I'll give you the information related to balance sheet or projected balance sheet for this year. So let me explain the projected balance sheet for this year. Assets, again we are having current assets and net fixed assets, 4 million and 8 million. This year's sale, as we predict 20 million, percent on 20 million sale we calculated. Same as total liabilities and owner's equity is mentioned here as per the previous case, and the percentage is also mentioned. I hope so you have to go through this case and try to solve. Definitely don't forget to ask the questions. I'm available for all your answers once you will put any question mark in my comment box. Thank you. If any further things, please let me know.
Thank you, Professor. We get good information.
Really thanks a lot for your lecture, and as per your instruction we will solve the given problem and let you in next class.
Thank you very much. And now we are going to be end this class with the instruction that definitely don't forget to like and subscribe the videos. I will give you more animated videos if you like this video. And please don't forget to write your suggestion in the comment box and follow my channel. Thank you very much and wait for my next video.